Episode 7 Financial Projections in Your Business. Plan Writing a Business Plan. Mastering Financial Projections. Welcome back to Start Your Business Today. I'm thrilled you're joining us for this in-depth session where we're diving into one of the most crucial components of your business plan, financial projections. This is not just about numbers. It's about painting a picture of your business's future that will captivate investors and guide your strategic decisions. Today, we'll break this process into manageable steps, ensuring you have all the tools you need to craft successful financial projections. By the end, you'll know exactly how to communicate your financial vision compellingly, helping you to attract the right support for your entrepreneurial journey. Let's dive right in. Segment 1. Understanding financial projections. First, let's understand what we mean by financial projections. Financial projections are educated estimates of future financial outcomes for a business. These projections include anticipated revenue, expenses, and the overall profitability over a specified period, often covering 3 to 5 years. Importance of financial projections. Now, why are financial projections so important? Let's explore some of the key reasons. 1. Guiding business decisions. Financial projections provide insights that inform critical business decisions, like when to hire, expand, or invest. You can evaluate different scenarios to determine the best path forward. 2. Attracting investors. Investors want to know if their money will generate returns. Solid financial projections are crucial in building investor confidence. They demonstrate that you understand the market and have a plan to achieve profitability. 3. Bank requirements. If you're seeking bank loans, detailed projections are often a requirement. Banks want to see that you can repay the loan, and detailed projections show your ability to generate cash flow. Segment 2. Key components of financial projections. Next, let's outline the key components you need to include in your financial projections. We'll cover 4 essential areas in detail. 1. Revenue projections. Start by identifying your revenue streams. This could include product sales, service fees, subscription models, etc. Next, estimate your sales volume. For instance, if you expect to sell 1,000 units at $20 each in the first month, your estimated revenue for that month is $20,000. To make this more accurate, look at market data or conduct surveys to see what potential customers are willing to pay. Expense forecasting. Clearly categorize your expenses into fixed costs, like rent and salaries, and variable costs, like materials and commissions. Be specific. For example, if you run a bakery, your fixed costs might include renting the space, while variable costs could include flour, sugar, and seasonal ingredients. Cash flow statement. A cash flow statement tracks incoming and outgoing cash to help manage liquidity effectively. For startups, this is crucial to avoid cash shortages. Create a simple spreadsheet that lists every cash inflow, like monthly sales, and every cash outflow, like supplier payments and utility bills. 1. Profit and loss statement, P&L. The P&L statement combines your revenues and expenses, giving you a snapshot of your net profit or loss. This document will help you assess the financial health of your business over time and should be reviewed regularly for performance improvements. Segment 3. Step-by-step process of creating financial projections. All right, now let's move step by step through how to create these projections, ensuring you understand what to do at each stage. Step 1. Research and collect data. The foundation for your projections is solid research. Start with market research, focusing on your potential customers, competitors, and industry trends. Use tools like surveys, online resources, or even interviews with industry experts to collect insights. This will form the basis for realistic and achievable projections. Step 2. Estimate revenue. Create a sales forecast that covers 1 to 3 years. Divide this into monthly estimates for the first year and quarterly for the subsequent years. Consider different scenarios. For example, if you're launching a new product, anticipate low sales in the beginning due to market entry barriers and then ramping up. It might look something like this. Month 1, 200 units at $20 each equals $4,000. Month 2, 400 units at $20 each equals $8,000. Month 3, 800 units at $20 each equals $16,000. Track the increasing trend and base future projections accordingly while considering seasonal factors. 3. List your expenses. Create a comprehensive list of all starting and operating expenses. Use a spreadsheet to itemize both fixed and variable expenses. An example structure might look like this. Fixed costs. Rent, $2,000 per month, salaries, $5,000 per month. Variable costs, materials, $1,000 initially, growing as sales increase. Don't forget to include startup costs for new businesses, usually in the first year. Step 4. Create a cash flow statement. Construct a cash flow statement using your revenue and expense data. It's essential to identify when cash comes in, sales, and when it goes out, expenses. This helps you to avoid the nightmare of insufficient cash to run day-to-day operations. Step 5. Create a profit and loss statement. Now, let's pull everything together into a profit and loss statement. This document combines all of your data to summarize your expected revenue and profit. This will help you understand your overall profitability. It can look something like this. Total revenue, $240,000. Total expenses, $180,000. Net profit, $60,000. Make sure to include subtotals for various categories that feed into the final total, which will help with clarity. Segment 4. Tools to aid financial projections. Now that we have a foundational understanding, let's talk about tools that can assist you in creating these projections effectively. Here are some popular options. 1. Excel or Google Sheets. Both are excellent for building custom projections and cash flow models. They provide flexibility in terms of formulas and data manipulation. 2. LivePlan, a powerful business planning software that guides you through the process of creating your business plan, including financial forecasting. 3. QuickBooks, a more comprehensive accounting software that aids not just in financial tracking, but also provides insights on cash flow and a host of financial reports. Segment 5. Best practices for financial projections. Now that you have the framework, let's talk about some best practices to keep in mind that will ensure your financial projections are effective. 1. Be realistic. It's tempting to inflate numbers. Don't. Investors will see through vague promises. Be conservative with your estimates. Update regularly. Your financial projections should be living documents that you revisit every quarter. Adjust them based on actual performance and changing market conditions. 3. Communicate clearly. Use visuals such as charts and graphs whenever possible. This will help convey complex information at a glance, making it easier for others to understand your financial vision. Make sure your projections are easy to read and understand for potential investors. Segment 6. Common pitfalls to avoid. Every entrepreneur faces pitfalls. Here are some common mistakes to watch for while preparing your financial projections. 1. Skipping research. Going straight to assumptions without data backing them leads to inaccuracies. Always start with comprehensive research. 2. Ignoring seasonality. Many businesses experience seasonal fluctuations. If you ignore this, your projections could misrepresent cash flow and revenue patterns. 3. Omitting contingencies. Always have a buffer for unexpected expenses. It's better to underpromise and overdeliver than the reverse. Segment 7. Real-world examples. Let's take a look at a real-world example. Consider. Company XYZ does a startup that projected its revenue based on solid data obtained from market research showing growth in their sector. They estimated revenues of $100,000 in their first year based on sales of 5,000 widgets, pricing them at $20 each. They calculated their expenses carefully. With a fixed cost structure of $50,000 per year and variable costs of $30,000, they projected a profit of $20,000 at the end of their first year. This diligent work enabled them to secure a $200,000 investment, which allowed them to scale rapidly and meet their revenue goals. Their ability to back projections with solid research and realistic assumptions was critical to their success. Segment 8. Conclusion and call to action. To sum it up, crafting detailed financial projections is not just an exercise in numbers. It's a vital step in the pathway to your business's success. The projections you create will inform critical business decisions, attract the right investors, and keep your operations running smoothly. If you found this session helpful, please hit that like button, subscribe to our channel, and share this video within your network. Post your questions or thoughts in the comments below. We'd love to hear from you, and if you're working on your financial projections, share them with our community for feedback. Are you ready to take your business to the next level? You can find more related materials to what we share here on bizbuddy.com.ng. bizbuddy.com.ng is a cutting-edge online resource hub, meticulously crafted to cater to the needs of entrepreneurs and business owners seeking a comprehensive repository of information, tools, and resources to bolster their business acumen. Thank you for joining us today. Next episode, we'll dive into another exciting and essential topic in your entrepreneurial journey. Until then, keep dreaming big and never stop building.